Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look across markets, talking about some of the themes that have been in play so far this week, what could be happening for the rest of the week, some of the risk events. Let's jump straight into the charts here. S&P 500, you can see a bit of a month-end pullback that we're seeing here after a pretty strong, generally, start to the year. We managed to hit fresh yearly highs yesterday, although since then we are about 1.5% lower. But still within the bounds of this upwards trend channel. And if you want to check out my video yesterday, I make an argument that potentially if we do drop back to it's the wrong one, to this area around 4,120, might be a good place to get back involved. But for now, month-end selling certainly at play, and there's a couple of fundamental developments. Some hawkish Fed speak from Fed's Mester talking about how basically Mester wants to continue lifting interest rates, and a very, very strong, much stronger than expected anyway, US JOLTS job openings report, which pushes back against the narrative of the labour market showing early signs of weakness, because this weakening that we recently saw in the JOLTS job openings data was interpreted as signs that labour demand is waning, which was going to be seen as a lead indicator of the labour market then waning. But, 10.1 million, way above the expected 9.41 million. That pushes back strongly against that narrative, very much supports the case that the Fed, or at least it supports the arguments being made by the Fed hawks, that they should continue with interest rate hikes because the labour market remains hot. Obviously, inflation still remains hot in the US, as we know. Service sector continues to perform well. Manufacturing sector not so great, which the ISM data later this week will confirm, or should confirm. But the jobs data on Friday, the official jobs report, should confirm that the labour market keeps humming along at a nice pace, supporting that argument for more Fed tightening. So that's what's going on in the US pretty much at the moment. Just quickly, have a quick look at the Dixie. Oh, that's the wrong one. There we go. Dixie just hit multi-month highs. Makes sense when stocks are falling as a result of hawkish Fed speak and strong US data. The safe haven dollar, which also enjoys Fed hawkishness and strong US data, rising a little bit. Bit of a month-end correction in two-year yields, despite the fact, usually when you had strong data in hawkish Fed, you'd see yields going higher, but this could just be a month-end play here in the US two-year yield, which in fairness still holds well above recent levels. Same story with the 10-year, holding above recent levels. Same story with gold, holding below earlier monthly levels when we broke out from that short-term uptrend. Oil, not faring so well, although that's probably more as a result of data that we've had out of other parts of the world. So what have we had? Well, look at this Chinese data. Manufacturing PMI worse than expected. Non-manufacturing PMI, still decent, 54.5 is okay, but weaker than expected, 55.1%. So there's some concerns now that China could be basically headed the same way as the US. Like the Chinese and the US PMI numbers are pretty much like exactly the same at the moment. And a lot of people still thinking that the US is headed towards a recession later this year. It's just whether this strong labour market can keep us out of recession for now is the question with the US. A couple of other interesting things as well. We had hot inflation data out of Australia, cool inflation data out of the Eurozone, Germany at least anyway, which probably contributing to the rise that we're seeing in the Dixie as people price out ECB interest rate hikes at the same time as they price in Fed interest rate hikes. Makes sense that you'd see the Dixie moving higher on that, or at least euro dollar moving lower. In terms of what we got for the rest of the week, Eurozone flash CPI data tomorrow, but I think we know the direction that's going to be headed in wake of the cool Spanish and German numbers. Lagarde speaking, obviously that'll always be interesting. US ISM manufacturing PMI, like I already said, should confirm that the manufacturing sector remains pretty weak. Jobs data, though, on Thursday and Friday should all suggest that things remain strong, and just be on the lookout for any further hawkish Fed speak, which could continue to support the dollar, support yields, weigh on risk assets like stocks. And you've also got Bitcoin, which has been coming under pressure. Let's just have a quick look. Yeah, it looks to be in a bit of a downtrend at the moment. So it's like, how far can this downtrend go? Are we going to fall 25k and test the yearly uptrend, get a bit of a pennant? Going to be interesting. But yeah, guys, hope you all enjoyed the video. Hope you all found it informative, and I will see you all in the next one.